Now let's welcome our next guest and good friend, Eddie Ghabour. Eddie is the co-owner of Key Advisors Group in Lewis, Delaware. He's also the author of the new book, Common Sense Bull. Operative words being common sense. So Eddie, thanks for being back on the show here today.
Thank you so much for having me, Dave.
You know, we talk all the time because we talk on the air, we talk off the air, and I know that you were pretty bullish for a while with the stock market, conservatively speaking. But now that's turned to being more bearish. And I don't mean just in the last month and a half, I mean even slightly before that. So what initially caused, in your mind, your turn from being more bullish to bearish a couple, 3 months back?
Well, the main thing is I track interest rates very closely, as you well know. And as the yield curve started to flatten and then become inverted, that's a big red flag for us. Plus, looking around the globe, everyone seems to be heading into a recession overseas. And as you well know, we are a global economy. In my opinion, it's impossible to have the entire world around us go into a recession and it not have a negative impact on us. Couple that with the fact that we've had unrealistic gains in the market. Yes, I've been bullish and it's fantastic, but at the end of the day, we always tell our clients we're going to be disciplined and most importantly, not greedy. So we have become a lot more defensive in our strategy right now because I think as we head into the fourth quarter in 2020 being an election year, we're going to see a tremendous amount of volatility. And it wouldn't surprise me if we start to see some corrections along the way as we head into next year.
30 seconds left in this segment. Why is the inverted yield curve such a big deal?
Well, traditionally speaking, it's been one of the most consistent indicators when you look back on an average of at least 13 months or so that there's a recession ahead. And look, some people are saying it's different this time. I'm not one of those that believes that.
We need to take a quick commercial break, Eddie. Stay with us. And you stay with us too. We have much more coming right here on the Income Generation. We'll be right back. And welcome back here to the Income Generation. I'm David Scranton, and we're talking to Eddie Ghabour, co-owner of Key Advisors Group, also the author of the new book, Common Sense Bull. So Eddie, I see what you're saying about internationally, but yet so many people today are pointing to the consumer. Consumer spending is still strong. They're pointing to the fact that if consumers just ignore the media, they can continue to spend, they can keep the economy going reasonably well. So is it possible for us to still have a relatively strong economy, but start to slip into a downward trending stock market because all the pressures around the world? Or do you think we probably have to go into recession to see the stock market turn?
I think what you're seeing right now is typical late cycle, right? Where the consumer is really strong, the market's having its, we'll call it one last run up. But look, right now, the consumer is what's keeping the economy afloat. When you look at all the other indicators, like manufacturing recently went down for the first time in 3 years. Eventually, it's going to impact the consumer. And when that happens, because keep in mind, these tariffs have not hit the consumer yet, and they will. If this trade war extends the next year, it's going to impact the consumer. Then the consumer confidence will go down, then it snowballs, and then you're looking into a recession. And our point is, instead of being reactive to the markets, be proactive. There's nothing wrong with being a little bit early to taking cash and putting it on the sidelines and taking advantage of the big gains that we've seen in the market. And that's our stance. This way, when we do have a correction, you have ammunition to be able to buy that dip.
And I love that thinking, of course. But the Federal Reserve seems like for the first time they reacted quickly, right? They're always slow to react. They want to have 4 interest rate hikes in 2019, and they had 0, and they immediately reversed course and are now dropping rates. So are they acting quick enough? Could they stave off the recession, next stock market drop, at least for a while? Or is it not going to be enough?
So I don't think we're going to see an imminent crash. That's just my personal opinion. And I think the Fed is usually, when you look back, they've been a little bit late. Who knows? That December rate hike that they did may have been the start of the recession that we may be going into in the next 2 years. I'm one that believes you cannot stop economic cycles from happening. You can slow them down and put band-aids on it, but at the end of the day, these cycles are going to happen. And it's been a long time since we've seen a recession. The signs are starting to show that there's some weakness, and I think investors need to take it seriously because, again, when I hear people say this time is different, I've heard that one before, and they've been wrong.
You don't have to stay and buy and hold in the markets. Having a little cash reserves allows you to be a capitalist and buy in upon the next drop. I love your thinking, Eddie. Thanks so much for being back with us here on the show.
Thank you so much for having me, Dave.
And you stay with us. We have more here right on the Income Generation. I'm David Scranton, and we'll be right back.